Hello, traders. Welcome to today's market session. In this analysis, we will conduct a comprehensive assessment to identify the critical price levels that are currently influencing market direction. Our objective is to leverage both technical and fundamental factors to determine where the market is likely to move from its current position. We will focus strictly on the data, the key support and resistance zones you need to be aware of, and explore potential directional biases across all major assets. Whether we are trending higher or consolidating near recent peaks, understanding these levels is essential for managing your risk effectively. Let's get into the charts and outline the game plan for the trading day ahead. The SPY closed the previous week at $691.66. Technically speaking, we remain in a very strong long-term bullish trend. However, we are currently seeing the market consolidate just below a crucial resistance zone. This tells us that a potential breakout is imminent. Whether that move happens this week depends entirely on two major factors. First, the heavy slate of economic data scheduled for release, and second, the highly anticipated Q4 2025 earnings reports. We are standing at a pivotal moment for the index. Let's dive into the levels you need to watch to stay ahead of the curve. Here are the outlooks and possible scenarios for the upcoming trading week. The market's direction will be primarily influenced by a busy economic calendar and key earnings reports. First, the bullish scenario. Stronger than expected US GDP data and a cooling core PCE inflation report on Thursday could provide the perfect catalyst. This scenario would likely see the SPY breach that $696 resistance level and target the $700 mark or higher in the latter half of the week. Second, the consolidation scenario. Mixed data or simply cautious earnings guidance from major tech components could keep the SPY range-bound between the $688 and $696 levels. Expect choppy trading if this occurs. Third, the bearish scenario. A significant negative surprise in the economic reports could quickly trigger sharp profit-taking. A daily close below the $688 support would be the first sign of a deeper correction, moving towards our major support area. Prepare for all three possibilities and manage your risk accordingly. To summarize, traders, we are currently standing at a pivotal decision point for the market. The SPY is coiled and ready for a major move, but the ultimate direction will be dictated by this week's economic data. Remember the key levels. Keep a close eye on the $696 resistance for signs of a breakout, and watch the $688 support to see if the bulls can hold the line. In this volatile environment, patience is your greatest asset. Don't chase the noise. Wait for the data and the levels to confirm the trend. Stay disciplined. Manage your risk effectively. And now let's conduct a deeper, more detailed analysis of the QQQ, specifically for the trading week of January 19th through the 23rd, 2026. The QQQ closed last week precisely at $621.26. It is currently maintaining a very strong bullish stance on the long-term charts, firmly above its key moving averages. However, like the broader market, it is now consolidating, sitting right at a crucial technical juncture. This tells us that an increase in volatility and a potential large directional move is highly likely this week. Here are the specific levels that define our master game plan. The primary resistance zone, the bull trigger area where sellers have consistently capped upside movement, is positioned between $626 and $630. A decisive, high-volume break and hold above $626 is absolutely required for us to confirm new momentum highs in the tech sector, targeting potentially $635 or higher. The immediate support level, our first line of defense and the primary buy-the-dip zone, is $618 to $620. A dip to this range, provided general market sentiment remains positive, presents a potential tactical buying opportunity for short-term traders. Major support, the must-hold level for the intermediate-term bullish thesis, sits much lower, around $610 to $614. A break and daily close below this level would be a significant technical warning sign and suggest a deeper correction is underway. The performance of major tech earnings this week from companies like Netflix and Intel will heavily influence which of these levels breaks first. The implied volatility for this week is around 13.78%, indicating an expected move of plus or minus about $8.94 from current levels. This confirms that the market is expecting a substantial move. Watch the charts closely, prepare for all scenarios, and manage your positions with discipline. And finally, a critical reminder for every trader watching: we do not predict the market, we react to it. The reality is, no one can know the future with certainty, and trying to predict exactly what will happen is the easiest way to lose your money. Instead of guessing, we focus on our key levels. We wait for the market to show its hand, and then we execute our plan based on that confirmation. Trading is not about being a psychic, it's about being disciplined, managing your risk, and reacting to the price action as it unfolds. If you found this analysis helpful, please take a moment to like this video and subscribe to the channel. Your support helps us continue to provide these high-quality market breakdowns every single day. Don't forget to hit that notification bell so you never miss an update on the SPY, the QQQ, or the broader markets. Thank you for watching, and as always, stay disciplined out there.